How's it going, friends and family? Today we're going to be talking about CME Group, a stock that was requested by a viewer like you. As you take a look at your screen right now, they're currently trading for about $294 a share. You zoom out for the past 5 weeks or so, 7.8% into the green. Now, mind you, for some people, their investment choices or the ETFs that they put their money into, for a full year, 12 months, the total return is about 8%. To see that in the past 5 weeks, you got to admit, that's kind of juicy. You zoom out past 1 year, 24% into the green. Past 5 years, 94%. And if we do, 15 years, 1,100% into the green. So what exactly is CME? So the CME Group operates several major financial derivative exchanges where folks like you and I can hedge or speculate on the future prices of assets such as gold, silver, Bitcoin, corn, wheat, and even crude oil. And then I think the next natural question that should arise in your head is, well, how do they make money? Well, their business model is pretty simple. If you think about it like a casino. They're not a casino, but just play with me, okay? CME, they own all of the tables and they collect a small fee on every trade and transaction and contract, regardless of who wins or loses. So, at the end of the day, CME, it's a classic toll booth business model that investors love. Shout out to MasterCard and Visa. They're also in the toll booth business. But right now, their stock valuation is kind of hurting, but that's neither here nor there. So CME's business model, it thrives on volatility and volume. Because think about it, as there's more economic uncertainty in the market and people start speculating that we're going to go into a recession, that makes people start to hedge against their money by speculating on gold and silver, right? So over the past 1.5 years, increased hedging against the US dollar and broader US risk has helped push gold and silver to all-time highs, and more people placing trades on those assets. So to make more money, they need more volume of transactions and contracts, which, by the way, for my 2026 top stock picks video, I did include a silver ETF and a gold ETF because I think in 2026, volatility and economic uncertainty is going to be the name of the game. And I'm not trying to be a Debbie Downer, but I do think we're going to see an April 2025 type of correction. I mean, take a look at cybersecurity. Take a look at software stocks. Take a look at fintech. The market's going to see a correction. I don't know when that's going to pan out, but volatility means CME is going to thrive. So on a single day, they process about 28 million contracts, which speak volumes to how popular their platforms are. And just in case you're wondering, no, you don't use CME to buy a literal barrel of oil or a bar of gold. You technically can after looking into it, but from what I found out, it's a headache. You're actually buying a future contract on what the price will be for that gold or for that barrel of oil. And then if you're correct, you get paid cheese. Does that make sense? So for a lack of better words, it's basically gambling and speculation betting on the future price of things that make the world work, like wheat, corn, soybean, and everything else. And now let's go ahead and talk about the recent developments surrounding CME. So they just reported their earnings as of like 12 hours ago, and I am shocked that CME does not get more attention. As a matter of fact, most of you watching this, you have never heard of this company. So how did their earnings go? Well, they beat on the top and bottom line expectations, and they're also going to announce their special annual dividend next week. So if you're a current shareholder, that pretty puppy might be like $6, $7, or $8, given their historical special dividends. But most importantly, what I got out of the earnings call is that instead of being a Monday to Friday shop like they are right now, they laid out the framework to being fully functional 24/7. Which means holidays, Saturdays, Sundays, you're going to be able to place a contract on the future price of silver. So I would imagine the volume of contracts, this is just me reading between the lines, it's about to go through the roof as people tend to drink on Saturday evenings and they're going to gamble after one too many drinks. So I think CME going forward, I mean, their business model as of right now, it prints cash, but going forward, I mean, think about it like this. If the stock market was open 24/7, as a matter of fact, I hope that never happens, because as a guy that covers the stock markets every single day, I love that on Saturday and Sunday, I can do other endeavors and projects. Because if it was open 24/7, dude, I don't know if I would be able to turn my brain off because I'm so passionate and enthusiastic about the stock market. I need that Saturday and Sunday to do other stuff. Otherwise, nothing would ever get done around the house. And now let's talk about the Chase situation. What are the things you need to take into consideration with CME Group? The first bullet point that I have is staying relevant. As of 2026, they're partnering with FanDuel and DraftKings in order to expand their services to your Uber driver, your kid in college, and even your barber. Because those two platforms, FanDuel and DraftKings, it's more readily available and mainstream with low barriers to entry for customers. Because if you think about it, it's not every day that the average citizen's gonna wake up and say, oh, I wanna bet on the future price of gold or crude oil. But FanDuel and DraftKings, right? So it kind of makes me laugh, but now people can gamble on the weather for tomorrow in your city. Like, is it going to rain? Is it going to snow? You have to admit, that's kind of hilarious. And who's also going to win the NCAA Heisman Trophy and stuff like that. So the fact that they're deviating away from physical assets, betting on the prices of that, but also including almost everything and anything, it shows you that even though this company is pretty old school and mature and established, they're not afraid of innovating to stay relevant. Shout out to you, PayPal. Shout out to you, Intel. I mean, Intel is now innovating, but I feel like they did it 10 years too late. You know what I'm saying? When their backs were up against the wall, and then they were like, oh, we'll make a foundry. But it's like, why couldn't you do that in 2014 or 2015? Why did you decide to do that after Apple decided to part ways with you and make their own M-series chips, right? It's like, I hate when companies innovate when it's their last option. I love companies like CME where they're killing it and they're crushing it, and then they decide to innovate on top of that. That's exactly the type of leadership that I have confidence in. I hate the play it safe, the play it steady, to keep things the way it's always been type of leadership. If I find out that that's who's steering the ship, I don't want to buy into that business. I want to buy into a business that's constantly pushing the boundary, trying to innovate, trying to think outside of the box. That's why I'm invested into Amazon, right? They have this day one philosophy and mindset where you approach every project and meeting with that day one mentality, thinking outside of the norms and the established SOPs. I love that about Amazon. Anyways, this is a video about CME. So bullet point number 2 is Google with a question mark, okay? They're currently in the process of moving and migrating their entire operation to Google's cloud, which I think is a huge win for you, Google investors, because that's going to be a crap ton of money going into the pockets of Google Cloud, right? And as a part of that deal, Google is making a $1 billion equity investment into CME. So both sides, it's a win-win in my opinion. And then the third bullet point that I have is competition. So when I was doing my research and homework on CME, I was hoping that they had a monopoly in what they do, but they don't. They have pretty fierce competition from ICE, ticker symbol ICE, Intercontinental Exchange, parent company of the New York Stock Exchange, the LME, the London Metal Exchange, and in Asia, you've got the Shanghai Futures Exchange and the Singapore Exchange, and the list goes on and on. Conversely, they're also the biggest player here in the US. So if you're a customer that's in Philadelphia or in Chicago or Detroit, why would you ever want to hedge these bets in Shanghai or in Singapore, right? You're usually going to gamble on the platform that has the most volume and other bettors. And friends and family, that's CME. So even though they do not have a monopoly, I would argue their scale is what allows them to crush it. That makes sense. Nonetheless, now let's go ahead and calculate an inherent worth for their stock price based on their own numbers and financials. And by the way, the spreadsheet that you're seeing on your screen right now, it's available exclusively on the Patreon. That way you can plug and chug with any stock that you want to, okay? So based on the GARP formula, which I created myself, I'm pretty proud of this because I worked on this project for like 3.5 weeks to figure out an intrinsic valuation for a stock price based on the revenue. Because most of us, we do it based on the free cash flow or the net income, But some companies, that doesn't really make sense because they are CapEx heavy or they have other variables that stand in the way of the free cash flow. So it makes it look like their stock price should be lower than they should be, right? And that's why I think the top line is a metric that we shouldn't ignore, because when you think about the earnings, those are the two key metrics, right? The top line, which is the gross sales, the revenue, and the other one is the bottom line, the net income. So why not have one based on the gross sales? And that's why I created the GARP formula. So based on their own numbers and their revenue growing at a rate of 6% year over year, which historically that's around where it's at right now, the cheese value per share, they should be roughly $229. Mind you, by the time you watch this video, they could be $296, $298. They're currently $294. So according to the GARP formula, that is kind of generous, they're overvalued. Now the price that I would hypothetically pay, baking in a margin of safety, that way I'm buying with some upside into the stock price to hit their chase value, would be $172. They're $120 above the price that I would hypothetically pay. Even though based on their current trading price, they're overvalued, I think the market's pricing in future success because of how volatile the current admin has been, the current party in power. And as a reminder, volatility means more money for CME. So as geopolitical tensions rise, CME is going to be printing cash. Conversely, if things stabilize and economic uncertainty is out of the window and it's not on the menu anymore, and every world leader starts holding hands, they start kissing and they start making up, CME is going to suffer. So in a world of volatility, even though their cheese value is 229, I don't think it actually depicts the macro situation that allows the tailwinds for them, if that makes sense. Because why else would people be hedging and betting on gold and silver so much? Because the valuation of that is going up. So they're also going to want to gamble that it's going to continue going up or to go down. More volatility, more profits for CME. Now, having said that, let's jump on over to the next model that shout out to me. I don't want to toot my own nipple too much, but I also created this alongside with the GARP formula. This one's predicated upon, in the earnings, the second factor that investors care a lot about, and that's the earnings per share, the bottom line expectations. So in fiscal year 2025, which they just wrapped up and reported prior to me filming this video, it was $11.16, which is pretty good. And the guidance laid forward for fiscal year 2026, the expectation is their bottom line per share should grow by 6%. I know. After looking into the numbers, I was kind of disappointed because having a trading multiple of around a 25 or a 26, which is what they usually trade for, I thought their bottom line growth would be a lot higher, right? Like 9% or 11%. But to find out that it grows at a really modest or a slow rate, I didn't expect that. But anyways, if it grows at 6% from $11.16, which is what they just executed, then I think CME in this year, in the next 11 months or so, they could reach a valuation of about 307 to 319. Now, keep in mind, the reason why the upside is not that high is because the growth of their EPS is not that high. It's related. And that's why I love my EPS forecast as an intrinsic valuation model, because it bakes in the profitability of the business in question, right? If we continue to play this game and we fast forward to 2027, CME has the potential to be 326 to 339. Now, obviously, this is all speculation, and I'm making an educated guess, okay? Don't take this to heart. This is not biblical truth. In the beginning, God created the heavens and the earth. This is not that, okay? 2028, talking about 353 to 366. So they're currently 294, but what this model does not take into account, as I just alluded to earlier, is the macro environment that is perfect, the conditions that are laid out for them to be crushing it. And the fact that they're going to be operating 24/7, but also allowing your Uber driver to now bet against the most random crap. I personally think their guidance of 6% year over year is just way too conservative and way too safe. I think even though on paper it says that CME in the next 3 years could be 350, 360, I think this is just way too conservative. Now, I could absolutely be wrong, but it's just what I think. So when it comes to the compounder chart, comparing CME against all of the various companies that we have analyzed on the channel in the past like 7 or 8 months, where do they fall? Obviously, the right side is the CAGR graveyard. I don't feel very bullish about them. As a matter of fact, bearish. Why is it called bearish, Amos? Because a bear strikes downward. So the stock price movement is going down. Then why is bullish a good thing? Because bulls have their horns and they attack upwards, which means the stock price is going to go up. Oh, wow. Did you just learn something today? Anyways, on the left side are the certified compounders. All the way to the left, you have Google and Amazon. They're in the S tier. The next category is in the A tier. That means they are excellent, really awesome, but they're just missing the mark of being superior, right? So that's Mercado Libre, Oshkosh Corporation, and Meta. Over here is the B tier, friends and family. That's exactly where I would place CME. I put them right next to Adobe, Salesforce, United Health, and Waste Connections. I think, fundamentally, CME, we're going to be looking at the numbers here in a little bit. Stick with me now. I learned that from the past, whenever I go too heavy into the numbers right up front, people's eyes start glazing over and they're like, I have no idea what the debt to EBITDA ratio is, and he's going on a rant about it. So I saved that for last. I think CME, it's a fantastic business operation, a compounder with no doubt in my mind. I mean, we saw their stock market performance. They crush, despite their revenue growth and their EPS growth being very modest at like 3, 4, 5% year over year. It's really, I'm kind of taken aback by that. I would expect their growth to be like 20, 30%, and that's why their stock price explodes. But that's just not the case. And as we're quickly about to learn, with their special extra dividend that they pay out every single year, they really do remind me of Progressive, the insurance giant, which is a company, a core holding in my personal portfolio. So CME, I mean, just think about it, guys. How could they afford that extra juicy dividend? It's because they print so much cash. You can only reinvest so much back into the business for R&D, for marketing, or to hire more people, and you can't necessarily grow the business any further. That would just decrease your net income because it would increase your overhead costs if you're pumping more money into hiring more staff while not really growing the business, right? So they're like, might as well just hand it back out to the shareholders. And that's why we invest into stocks, right? The value proposition, the ROI that we get from the business that we put our money into. Share buybacks is another way that they can reward their shareholders. All I'm trying to say, friends and family, is that a company with too much cash is a good problem to have. A company that also pays a special dividend every handful of years is Costco. Every single one of these companies, Progressive, CME, Costco, to pay that extra dividend on top of the normal dividend, sign me up. It's definitely a business that I am going to add to my personal watch list. So shout out to you for requesting me to analyze this company, because I had no idea that they existed prior to you requesting it. So I'm actually grateful for you. But at current valuations, as we learned from the inherent worth models, I do think they're overvalued. At current valuations, I'm not going to buy into them. And that's why they're going onto my watch list, because if a scandal breaks out or the market punishes them very harshly to the point where it makes no sense, I would like to buy into them. Now, I'm not insinuating that anyone else buy into them. It's just me conveying how I feel. Say it with me. Do not copy the cheese guy that is projecting his voice in a louder manner. Do not copy the cheese guy. Now, you can go ahead and call me what you want, a Vietnamese or Nigerian, but personally, this is my most favorite portion of the video, where I add some color and commentary to their financials and numbers, because at the end of the day, I'm a value investor. I care that the company has tangible proof that they're high quality. I do not care what some guy on X, stock tweets, or on Reddit says about a company, the narrative, the speculation, the hype. I don't care. I care about the data and the numbers. And that's exactly what we're about to do right now. So once we jump on over to their P&L, the income statement, by the way, I have a stock analysis referral link in my description. It gives you a discount on top of whatever promo they've got going on. Their top line growth has been pretty consistent, except during the pandemic in 2021, it dropped by 4%. Take a look at this. It's not exactly a compounder in terms of their gross sales, but it is pretty reliable. Goes up and to the right. Like I was saying, right? Their growth rate, nothing to write home about. Like, I thought a company that is crushing it in their performance like that, 3,600% for the maximum timeline, just taking into account the share price appreciation. I thought their gross sales were going to be 30, 40, 50%, but that's just not the case. So I was kind of confused by that. I'm not going to lie to you. But if we scroll on down and take a look at their bottom line per share, I think that's where the excellence is really seen, the merit of CME. Ever since the pandemic, they've just been crushing it and their profitability has been improving. It's really good. And here's something else that I want to call out. On the P&L, on stockanalysis.com, you can actually see their profit margin. What's their take-home pay after accounting for the taxes, the overhead costs, the compensation that you pay your employees? Dude, it's 61%. All I'm trying to say is that's very low overhead costs and expenses to run the business. And that's why I think the toll booth business model is appealing to a lot of investors. It doesn't matter what's happening left or right, top or down. As long as people are using whatever, they get paid. Just like Hess Midstream. It doesn't matter what the price of an oil barrel is. As long as there's oil moving through their pipes, they're going to get paid. A company that I also just covered and I learned pretty high quality. So toll booth business model, that's the result that you see a 61% profit margin. Now, obviously, with Hess, you're not going to see margins that high because they're in the oil and gas field, which requires a crap ton of CapEx, but that's for a different dialogue. If we jump on over to the balance sheet, I think it's going to be spectacular, right? $4.7 billion of cash on hand. The more cash that you have on hand, the better you are prepared for any setbacks, any scandals, any headwinds. Because if you're short on cash, and you get a legal settlement or any kind of speed bump arises, this company is going to suffer, meaning they might have to file for bankruptcy if they're way too leveraged and they don't have enough cash and they don't produce enough cash flow. So a company that's flushed in cash through the production of the free cash flow, but also on their books, is a positive. So when I'm looking at the cash and cash equivalents, I want to see a trend that's stabilized at around whatever number that the board of directors dictate, or a trend where it goes up and to the right. Now for CME, that's exactly what I'm seeing. So as I'm adding commentary to that, hopefully you understand that I like what I see. Number one, on their books, their cash situation, phenomenal. Total debt situation is $3.4 billion. Now, what's crazy about what I'm seeing right here is for most companies, they usually have a game plan where their total debt remains the same year over year. Like it should not exceed $1 billion. As a company, as an enterprise, we will be diligent with our capital so that our total loans and obligations stay consistent. Sometimes it goes up, sometimes it goes down. In the case of CME, dude, it's going down year over year. So they're paying down their loans, I'm assuming with their excess cash flow, which is a really good thing, right? Think about it in your situation, like your student loans. $80,000 versus $15,000. Doesn't the 15 grand sound a lot more appealing? Which means after covering all the loans, they still have $1.3 billion of cash on hand. This is quite spectacular. I'm not going to lie to you, I am very impressed. Now, on the cash flow statement, the first thing that I want to, looks like fiscal year 2025 data is not here, so let's jump on over to fiscal EI, and there it is. The first thing that I'm going to be taking a look at is their CapEx. Obviously, this is not a company that is manufacturing phones or planes or anything really, right? So their CapEx, in terms of how much money they pour into factories, manufacturing, and production, not going to be that much. But the reason why we see $77 million in CapEx is because of their Google Cloud migration costs. It costs money in order to move from their own local cloud into Google's territory. So for me, $77 million, dude, that's a splash in the ocean. That's nothing, right? Especially in comparison to how much cash they have on the books. And we can verify with their free cash flow, $4 billion. You tell me, does $77 million in CapEx sound like a lot in comparison to $4 billion free cash flow, especially their free cash flow margin being 63%. Dude, this company is so efficient. I don't think you guys understand. Usually, a software, low overhead kind of a company, their free cash flow margin is like 15-20%. To see 63.8%, that conversion rate, dude, it is so spectacular. Now, I want to spend some time talking about their dividend profile because on surface value, it looks phenomenal, right? 3.6% dividend yield, 44% payout ratio. Amos, what does payout ratio mean? It means out of their bottom line per share, their profits, how much of it is allocated towards paying the dividends? Only 44%. Not bad at all. But then on the flip side, you might look at the dividend growth rate and be like, dude, this company sucks. They're cutting their dividend. No, it's because stock analysis bakes in the special dividend as a part of their normal dividend. And so when it goes down to their normal dividend value, they consider it a cut. So take a look at your screen right now. Here's what we're seeing. In 2016, you got 60 cents every 3 months or every quarter. And then bam, they hit you with a special dividend of $3.25. And then the cycle repeats, but that dividend is increasing. It's going from 60 cents every 3 months to 66 cents. We can repeat that process. But one thing that I'm seeing is since 2021, that special dividend payout, it's growing at a very aggressive rate, right? It's going from $2.50 to freaking $5.25 and then $5.80. So if I were to make an educated guess, I'm thinking this next special dividend that's going to be paid out next week, or I guess announced next week, it's going to be $6 and whatever cents. Could be wrong, but that's what I think. However, friends and family, this is where I am a little disgruntled with their capital strategy and game plan, because in lieu of the special dividend, I think a better use of the excess cash is to buy back the shares so that they can financially engineer the EPS growth to be more aggressive and stronger year over year. If we jump on back over to their P&L, their income statement, take a look at what I'm seeing, right? The growth rate of the EPS, I mean, obviously 2017 is an outlier, okay? It usually grows at what, like 20%, 1%, 19%, 9%. I feel like the growth would be a lot better if the shares outstanding were less. Because if you divide their profits by the shares outstanding that's decreasing year over year, it's going to make it bigger. It's mathematical. It's super simple to get, right? So their shares outstanding, it's at 360 million and it's increasing year over year. So how about reduce the special dividends and buy back the shares? That's what I would advocate, because it doesn't make sense on why they're diluting the shareholders while also doing a special dividend. I would rather see the shares outstanding situation decrease if that also meant the special dividend also decrease, because then their EPS growth would be higher, which means they would trade for a higher price, because say like right now their PE is a 26 and that's predicated upon an EPS of $11.16. This is what I mean by cooking the books, financial manipulation, financial engineering. If they were to increase the EPS to like $12.50 by buying back the shares, artificially inflating the profits per share, and it stays at a PE ratio of a 26, their stock price would be a lot higher. I mean, it's just the simple cause and effects, right? If they were to artificially inflate the EPS by buying back the shares, and we times it by their current trading multiple of 26.4, their stock price could be $330 instead of $294. Do you see what I'm trying to say? Why not buy back the shares? I think their current approach of how they're handling their excess capital, it's holding them back from potential share price appreciation. Having said that, I still think it's a pretty excellent company. It's just stop issuing more shares. Now, having said that, I really want to say this part, okay? Please keep in mind that I'm an idiot. I'm the type of idiot that walks away from a 6-figure salary in order to do YouTube full time. So just so you understand how stupid I am, okay? I make what, $400 a month from doing YouTube every single day of the week? Do you think that's worth it? I don't know, you tell me. So all of this in this video, it's gonna be wrong and inaccurate because I'm stupid and I'm an idiot. So please do your own research and due diligence so you can formulate an opinion on the company that's not from me. That way you understand whether or not you like them. Just because I made a dedicated deep dive video on the stock, it does not mean that I endorse or recommend it. Why am I saying all of that? It's because the other day, I got a hater comment that said I'm pumping stocks. And I'm like, dude, I am not pumping stocks. Pumping stocks? I think about the YouTube creators that put in their thumbnails and their titles phrases such as, this is your last chance to jump in. This is gonna 20x. This is the final opportunity. That's pumping stocks with the manipulation of their words. I'm literally just analyzing a company and telling you what I see. I'm not trying to tell anyone what to do with your cash. Whatever you choose to do, I don't care. You can continue to subscribe to that OnlyFans account. She only shows photos of her feet. I don't care what you do. But one thing that I refuse to accept are people lying and saying that I pump stocks when I just make dedicated deep dives about every stock. Like as you learned on the compounder chart, I also analyze stocks that I do not give a rat's butt about. Does that mean I'm pumping those stocks? No. I guess you can see I just feel really disappointed and frustrated when people categorize me and bucket me into the same tier of people that are actually pumping stocks with clickbait titles and with misleading price predictions for their own manipulative gain. I hate that I'm associated with that, but it is what it is. Having said that, I love you guys. Stay safe. Good luck in the stock market and do your own research. I'll talk to you guys really soon. Peace.